I rented a car in Europe once and I returned the car as a good car renter would. But for some reason, they did not think I returned the car. And they actually put me on Interpol for stealing a car internationally. And that went on my credit report. Needless to say, I did not find out about it until a few years later.
Welcome to One With the Other Way, a podcast about your journey and finances. I'm your host, James. Today we have Wanda with us, and we are continuing our home buying series. This is part 2. We are discussing contingencies, going under contract, and escrow. We hope you enjoyed this episode.
Considering right now, just in buying a house, we understand that we're going to emotionally get involved in it. I mean, we know that we're humans, right? We're going to get all involved in this new place that I'm going to buy a home and I'm going to have all my stuff there and it's going to be perfect and have everything just the way I want it. And we get all emotional. And then we start to say, you know what? Let's try to quantify this because this is a rational decision I'm going to make. And so then you start to find that you add these things like contingency clauses, right? And then we're talking contingency, right? And then we're talking a mortgage contingency. Oh, well, you said you thought you could buy that house. You said you had the finances. It looked like you had the finances, but we looked at your taxes from 2002 and guess what? Big no-go or whatever it is, right? Or inspection contingency. That house looked fantastic. Yet when we pulled the cabinet out there in the kitchen, we saw that there's a leak and we have no idea where that leak's coming from, nor do we have any idea how much it's going to cost to pay. And then, will you look at the termites? Oh, look, there's a mouse family down here. What is going on? You have an inspection contingency. How much is that going to cost to fix? And this is actually an interesting one that's coming up more and more, appraisal contingency. And then appraisal is like, we think that this house is worth $400,000. We make an offer for $400,000. Then some appraiser comes in and says, you know what? This house is only worth $350,000. But the buyer agreed to $400,000. The seller agreed to $400,000, and the appraiser is going to come in zeros and ones and say, hey, only worth $350,000. And the bank's going to say, yeah, no go. You can't buy that house because it's worth less than what was offered. Now, even in that little contingency, you can air quote, bring $50,000 to the table and purchase it.
One that I've heard a lot was buyer sale contingency. If they aren't able to sell their own house in time to have the money to buy the new one, that could be a contingency clause.
That's a contingency clause. Like I make an offer and that's contingent on me selling a house, which is, it's done more and more when the market is slow, because the thought is if I can't sell my house, then I don't have the money to move into the new house, which is another issue. Because zeros and ones might say that you shouldn't be moving houses, but that's another issue, right? But it's a contingency clause and an offer, which is different than some of these contingencies that we're talking about, right? So we've talked mortgage contingency, inspection contingency, appraisal contingency, insurance contingency. And these are all reasons, these contingencies, that the house sale does not go. And then we go into well, I can't get my house because... And this is the insurance contingency is an interesting one. Insurance contingency says that if you buy a house, right, and the house is worth, $400,000, you have to be able to insure it for $400,000. So you have to get a homeowner insurance because the bank wants to know if the house falls down or breaks, that someone's going to step in and pay for that house. The bank wants to have insurance on the home to take care of that. And sometimes there are periods of times that you cannot get insurance in certain properties. I'll give you an example. In our town, we have a grove of eucalyptus trees here. And we had a random arsonist, and he was coming around and apparently just setting fires, randomly around the town, California. And so those could create chaos. Eucalyptus trees are known to encourage fires, we'll say. So the insurance companies would not insure any of the houses that were lined along the eucalyptus grove. So if you bought a house there, you couldn't get insurance for it, right? And then no house sale happens there. A title contingency is interesting because the title contingency is if someone else actually owns the house. Now, we could talk all about titles and titling of land and property, but basically that's saying that you thought the seller owned the house in order to sell it to you, but something wasn't done correctly and he really doesn't own the house. And that usually happens if, for example, maybe they inherited the land or the house and they didn't do the paperwork at the time appropriately. Important that when you settle an estate and you get property, that all the titling is done. Otherwise, you run into problems at a later time. And then I think this last one is this home sale contingency. I think that's the one you're referring to. Normally, it's done, somebody makes an offer on a house and they say, I'm only going to buy the house if I sell my house. And then normally some period of time is given there. And so, we were talking a little bit about, we were getting into our little theory heads, I think, James, that you
Yeah.
like to do. And we were talking about a little bit about cognitive science and behavioral, how we react to the different things. And buying a house can be quite emotional. I think Peggy talked about it. It's a lot of emotion involved. I mean, I like to say it's just a place you put your stuff. So try to take the emotion around about it. And yes, I have a warped sense of humor, but really it's a place where you make memories. It's a place where you celebrate around a Christmas tree. It's a place where you watch the fireworks go off in your backyard. In some cases, legally and illegally. However, it's a place where you have the memories, right? The relationships, the people that you sit down and maybe invite over for coffee. And so there is that entire emotional part of a house. Yet we try to, as financial advisors, take a look at it in terms of the big picture. How does it fit into your life? Zeros and ones. Is this something that you're ready for on the financial side, on the zeros and ones? So you can have the best new memories created forward because you don't have to worry because you got the zeros and ones taken care of.
Well, so I was going to bring in next. The idea is that, we're on episode 2 of this home buying series.
Right.
You got your down payment saved up. You've met with a realtor, you met with a mortgage lender, maybe you're approved already. You've saved up all this money, you're putting it down for a
Right.
down payment. We
Right.
talked about contingencies.
Mm-hmm.
What other kind of expenses? There's this term good faith deposit. It seems to me that this could be an area where money could just flow out very quickly in a very short amount of time without enough forethought. So what does that
Mm-hmm.
look like working with a financial advisor to have these zeros and ones planned?
Yeah, so money tends to flow out very easily when you are buying a house, and I like to plan around 20% wiggle room. So if you're talking about a $400,000 house, we're talking about, $80,000 in wiggle room for things like good faith deposits, for things like inspection. Let's say the seller does not want to do an inspection. I think it's a big commodity. I think an inspection should be done. There needs to be wiggle room because you don't know all the possibilities. As each one of us are unique, each house sale is in its own way unique. Yeah, some of them are very routine, but in a lot of cases, there's that one little thing. And both Peggy and I are in the process of buying houses. Her speed bumps are different than mine. Mine more to do about, oh, hey, you wanted that pool. We really think that you really need to give us some more money for that pool. And you need to do it right now because we don't know if you're going to pass the mortgage contingency when the house is finished. So just to be safe, let's go ahead and get you to write us a check for $80,000 for that pool. so which is a unique situation, right? Again, looking at the value of the house, right? To say this is unique to me, right? In my 35 years, I've never seen any other home buy go through with that. That's always a first for everything, right? And even as a financial advisor, I may not know everything, but I do know that 20% is a good planning factor to have for wiggle room for whatever it is the case might be, right? Whether it's getting something through regulators for a home build, as Peggy's working through, or whether it's just, I need more money because we're putting in a pool and we want to have some of your money for it before.
Are you saying that this 20% on top of the amount that you saved up for a down payment?
Yes, different. Yeah. The home down payment should be in its own pocket. So you should have like the mortgage set. You should have the home down payment set. And then you should have this wiggle room set. And so if you don't need that money for the house sale and all that, the house purchase, then it can then slide over to doing things like buying furniture, making the window the way you want the window to be, or whatever else that's going to happen that you haven't quite accounted for. But there's always going to be something, right? Maybe it's going to be on the front, maybe it's going to be on the back after you move in.
We're talking all these zeros and ones,
Right.
kind of going into what are you seeing as you work with people? What are some of the biggest mistakes you see people make in the contract phase of the home buying process or being in escrow? What kind of mistakes are you seeing?
Okay, well, I'm going to put it out that I think the biggest mistake people will make is not getting a home inspection. I will tell you that you are about to buy an expensive item if you're buying a home. And that home should be inspected. If the seller doesn't want to inspect it, you should be inspecting it. You should know everything about that house before you buy it. And so I think that's going to be like the biggest mistake.
Now, talk to me for a second about people who are in this phase. I've seen this
Mhm.
online. It seems like kind of
Mhm.
a horror story, but where maybe
Oh,
the loan is under one spouse's name and the other spouse does something else and maybe buys a car or buys another large ticket item that affects their credit in the process of this home purchase. Have you
right.
encountered anything like that before as an advisor, or have you heard of anything like that?
So, yeah, I have heard of those things. So, normally when you're thinking about buying a house, I've got a mentality about credit reports, and I think they're unimportant but well marketed. With that said, everybody wants to know their credit score and blah, blah, blah. I get it. The reality is, you should be familiar with your credit history of both people that intend to buy the house. Because if one person has a suspicious or suspect financial history, then that could cause the whole thing to fall out from what we call escrow, right? So you have generally two people coming in to buy a house, and both people's income are used to determine whether or not you can afford the house, because the bank is interested that you can make the mortgage payment. That's their primary interest. After they ascertain that you can make the monthly payments, right? Then they'll turn around and say, okay, let me look at your credit score and let's see what kind of risk I'm taking as a financial institution to help you buy this house. And then they're going to assign some kind of interest rate based on your credit history. And so if there's something in your credit history that's suspect, right? This is something to take a look at. It's not a bad thing. I will tell you that I've had a question. I should probably tell you this as a financial advisor, but I rented a car in Europe once and I returned the car as a good car renter would. But for some reason, they did not think I returned the car. And they actually put me on Interpol for stealing a car internationally. And that went on my credit report. Needless to say, I did not find out about it until a few years later. because because you know who steals a car, and they had the car, and they had the keys and all that, whatever. Somehow administratively they didn't work it out on their end, and so I had to go to my credit report and fix that up. Just because somebody has something on a credit report doesn't mean the world is over. Although that was an interesting one. With that said, the first thing they do is they look at the two people. Do they have the income to support the mortgage? And then the second thing they do is look at the credit history to see what's going on. And those are times that could be self-discovery, like, oh, look at that. And so so there's a lot of credit monitoring services. Yes, right. No.
Wanda, international
Yes.
fugitive, first time home buyer.
I know, right? And a financial oh my gosh. So that was a few years ago, but it was a fascinating process to go through, because it was, of course, in Europe that I rented the car. So you have to go through all the international stuff. But anyway, it doesn't mean you're a bad person. It just means that something happened in your life that was interesting. To be clear, for the record, there was no stolen car. The car was returned and I owed nothing. Just so to be clear.
I don't actually believe that you're an international Grand Theft Auto
I know.
felon. The question that I'm coming to now is, so you've got these planning, you've got this extra 20% on top of it. What does your communication look like with clients that, maybe they are in a hot market where the price keeps going up, they are in a bidding war of sorts.
Mhm.
What do you say to a client? Because we talked about this idea of prospect theory of
Mhm.
loss aversion. They
Right.
have this house in their fingertips, and
Right.
someone else keeps trying to take that house from them
Right.
in their eyes.
Mhm. Mhm.
What do you say as a financial advisor in that kind of moment with them?
So this is the time that a financial advisor is invaluable, because they're going to take you out from the behavioral side and move it into the zeros and ones. We think, hey, cool, I won $10, right? But then if you lose $10, right? Oh my gosh, the $10. But it's the same thing, but add like 500,000. oh, cool, I got this house. Life is good. Everything's spiffy diffy. Yet now I'm in a bidding war and I'm going to lose the $500,000 house. And so it's that magnification from $10 up to that $500,000. And then it's important for you then to step aside and take a look at your financial plan and how this house fits into that financial journey into your real life, and not get yourself so wrapped into that loss aversion, like, oh my gosh, I'm going to lose a house. It's not the only house. There'll be more houses. And with that said, I've gone through the same emotions myself. I remember when I was younger and I felt like, oh my gosh, this is the last piece of land on a lake that will ever be out there. But the truth is, there's going to be more land on other lakes that are possible, and you will build other houses and live in other places. It's all part of life.
So knowing that, you mentioned
Mm,
earlier the term
mm,
buyer's remorse. When do
right.
you see that usually come into effect, and how do you deal with that in the conversation with a
Remember,
client?
as soon as you get that $500,000 house, you're like, got the house. Oh, but look, the corner over here needs paint. And it looks like it's chipping on the outside over here. And then you start to have all the negative thoughts that come into that thing, like, again, that $10 example, that $10 not so much. And then you're looking at the $500,000 house and you're saying, you know what? I spent $500,000 in the paint. I'm going to have to I'm going to have to get a new refrigerator. Holy mackerels. And I just spent $500,000 on a house. Look at that. That's terrible. And so you start to beat yourself up a little bit on the emotional side. And again, stepping back is always a good idea. Stepping back and saying, how's this fitting in my real life is important at this time.
Thank you for listening to today's podcast on
Mm.
contingencies. What could go wrong? Maybe
Ah.
being on Interpol's Most Wanted. But
Yeah.
if you want to actually meet with a financial advisor, talk about what a home buying process looks like for you, you can meet with Wanda at financesforreallife.com. We'll have the schedule appointment button on the top right of our homepage. You can continue listening to this podcast on Apple Music, Spotify, and YouTube. If you want to hear something that you haven't heard before, you can email us as well at office@financesforlife. We'd love to talk to you. Hope you have a good rest of your day. Thank you for listening. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Finances for Real Life, a registered investment advisor and separate entity from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.